Howdy there, folks. Welcome in to today's video. So we're talking about selling everything, going 100% cash. You know, of my time on YouTube, I don't think I've ever seen a week where I saw more comments about people are selling everything and going cash now. And I saw this on, obviously, YouTube comments. I've seen this in Discord. I've seen this, a ton of various places where this was really the week that, broke a lot of people. Just to be quite clear, like a lot of folks had been holding up pretty strong, but had been weakened, and then this week was just devastating to folks. And a lot of folks just said, by Friday it was like cash it out. And a lot of folks, I read through a lot of comments and whatnot. A lot of folks are kind of like, I'm going to reassess the market in 30 days, 60 days, 90 days, but for now I'm out of the market. And that's just where we're at. And so I want to show you in this video some very, very important things that if you're thinking about selling and cashing out, that you should at least consider before making a move like that. And I think some of this is very, very important because people, I think, are thinking certain things are going to happen that may happen or may not happen, but it's very important you understand the context behind these things so you can at least make an informed decision and not make a decision based upon emotion. Because I think what it came down to for a lot of folks this week is I think it came down to an emotional decision, right? Where you're just in so much pain and you just want the pain to end, essentially. And the way you end the pain is sell out of all your stocks, right? And that's just what a lot of folks did this week, okay? And so, I thought this was just kind of an important video to give for everybody out there because I'm sure there's a lot of other folks watching this video right now that you're thinking about selling everything, right? And just, cashing out of the market and just being like, maybe I'll never come back to the market, or maybe I'll come back in, 30 days, 60 days, 90 days, next year. It's the way I hear a lot of people talking right now, okay? Now how do we get to this place? I think it's very important to understand, like, how did we even get here? The NASDAQ's down 22% plus year to date. This is the worst start to the year for the NASDAQ ever. Like, I've never seen a year this bad for the NASDAQ to start. Not in 2007, we didn't start this bad. 2008, we didn't start this bad. 2009, we didn't start this bad. That's during the great financial crisis. We didn't start this bad in 2020. We didn't start this bad in 2000 when the tech bubble was blowing up. Never did we start a year through the first 4 months of the year where the NASDAQ was down over 22%. This is insane. Like just to be quite frank, this is insane. And so I get it. Like, I understand, especially for folks that haven't been in the market too long. Like, you come in and you've been in the market for, let's say, a year or less than a year, you come into the market and it's like, holy smokes, man, this thing just drops every day. I buy any stock and it just drops and drops and drops. I can understand how people get to that place. But it's much, much bigger than that, okay? Much, much bigger than that. Because here's the thing. For a while, especially in 2021, it was just a lot of the more speculative names that were dropping, a lot of the retail trader investor type names, right? Which I have a list of stocks on TradingView, essentially, that I keep track of that are what I call trader investor stocks, and retail side, that are very, very popular. And those stocks, have obviously started to falter probably around February 2021 and just got worse. But that was one thing. But the new thing that's happening is what I think is really scaring folks and making folks get out of the market. And that's when we lost everything else. We lost it, man. We lost big tech. And like no one really blinks an eye if small cap stocks and mid cap stocks are getting hammered in growth stocks, because people just start saying, oh, it's just some speculative companies that no one really cares about. No one blinks an eye. They're not even paying attention to it. Whatever. But boy, when you start having big tech stocks that have hundreds of billions of dollars in market cap, or dare I say $1 trillion plus of market cap, dropping like they're penny stocks, and let's be very clear, that's what these stocks are doing. They're dropping like penny stocks. That's what Netflix, what that just did, it's acting like it's a penny stock. I've seen penny stocks hold up better than Netflix has held up. I've seen penny stocks hold up better than PayPal held up. Shopify, these sorts of companies, some of the biggest companies in the world. We're at a moment in time. Nvidia is starting to trade like a penny stock. Look at that stock on a 1 month chart. Stock's down 35 to 40% in the past 1 month. They didn't even report earnings in the past month. Like, that's just how insane this stock has gotten hammered, right? And so you have all these stocks just getting absolutely devastated. And folks are looking at this and they're like, dude, if these stocks are getting hammered as well, there's no hope for the market. When you're talking about these, right? Housing stocks are all at pretty much 52-week lows and multi-year lows. Banking stocks are as well. A lot of retail stocks are, and when I say retail, I mean like retailer type stocks, right? And then you get big tech down like this, just getting absolutely obliterated, and people are just like, there's no hope. There's no hope in that sort of market, right? Now, on top of that, to add, I guess you could say, insult to injury, okay, you got this situation happening, which is ARK ETF. So Cathie Wood came to super fame, I would call super stock market fame, basically in really like 2020 and 2021, right? She came to super fame, and she almost became like a hero to some folks that are in the retail investor space, right? And seeing ARK ETF down almost 70% now from its highs, people see that and they're like, dude, if Cathie Wood of ARK ETF is getting this destroyed with her team, and somebody that was kind of looked at it as a hero, they're like, what chance do I have in the market as a little guy? And so this is just kind of demoralizing. It's like seeing I don't know, in a Marvel movie, seeing Iron Man die or something like that. It's just like, it's just devastating. And it's just like, I guess there's no hope. And I mean, her with her team and, the long-term outlook and all that stuff, it just hasn't mattered in this sort of market. And the ETF's down around 70%. And people can get through like a 10% drop, a 20% drop, even a 30% drop. But when you start talking about 70% in a little over a year, that's when people lose faith. They lose faith completely. And they're just like, yeah, what chance do I have in the market? And so this is how you get to this sort of place, right? Now, I want to explain a few things very, very important to folks. We're going to talk about the great financial crisis and what happened with the markets in that time. I'm going to show you inflation data and how this is going to impact the stock market, which I think is very, very important. And if anybody's watching this that has sold recently or is thinking about selling, these are absolutely things you have to consider before making a move like that, okay? Because this is the type of stuff that will move the market up or down, okay? And so it's very, very important. So, first thing I want to talk about here is obviously United States, we had not just a bear market, we had a crashing stock market. We had a bear market, by the way, is referred to as a time period where the indexes go down more than 20%, okay? And so for some reference, right now we're in bear market on the Russell 2000, we're in bear market on the NASDAQ, we're approaching bear market on the S&P 500, and we're still quite a bit away from a bear market in the Dow 30, okay? And basically, in the great financial crisis, the simplest way I could break this down, because a lot of folks are looking at this and like what happened there, right? Basically, to put it simply as possible, is credit got turned off, okay? And ask anybody who paid attention to money or cared anything about money from 2007 through the end of 2009. You couldn't get a loan, okay? I'm talking car loans, home loans, business loans. They basically shut off the credit line to the United States of America. And it became like a joke. And it was like near impossible to get a loan for anything. And I'm telling you, when you dry up the credit markets of the United States of America, you shut down the economy of the United States of America. So much of our economy is dependent upon credit. And if all of a sudden you can't take out loans, like okay, go around a city, go around my city, Vegas, go around Phoenix, Arizona, go around any city where you see construction, okay? Guess how all that construction's funded. And I mean like 100% of that construction. I don't care if it's homes, if it's commercial space, retail space, it doesn't matter what it is. It's all financed through debt, okay? And through the capital markets. And so if all of a sudden you shut off credit, like imagine your sink's running with water and you just shut it off, that's essentially what happened in 2007 through 2009. And when you do that, you shut down the U.S. economy. Let's be very clear about that. And this is how we got to a moment where housing collapsed and the stock market collapsed and the economy collapsed all simultaneously because they shut off credit. And like I said, you shut off credit, you're done, okay? That's just it, okay? And so that's why, we basically had this dramatic situation. And how we got to that place is through the derivatives market, and the Fed made some mistakes. It was a bunch of things you could say, got into the, politics and some moves that were made that weren't the smartest there, leading up to those years. I could put it on probably 20 different things, honestly, but all this like, accumulation of stuff is basically what happened there. But at the end of the day, the credit markets dried up, and you dry up the credit markets, you're done as a U.S. economy, okay? And what happened as a result of this is the NASDAQ fell over 50%, the S&P 500 fell over 50%, and the Dow fell over 50%. All the indexes, Russell, fell over 50% as well. By the time it was all said and done, all the indexes had fallen over 50%, okay? Now, this is a moment we're going through right now where some folks are, and I can tell you some folks that have probably sold this week are looking at this and are like, man, we might be in another one of these situations. We might be on, this, what we're going through right now, this might be the 2007 scenario, or maybe we're in 2008 right now, and it's just going to get worse and worse, and the NASDAQ might be down from the peak. The NASDAQ's probably down, I don't know, maybe 24% right now, or maybe 25%, but people are looking at that and saying, dude, it might have another 25% to go. We might go down 50%, just like happened in 2007 to 2009. And I can understand that context. And I can tell you, if they shut off the credit for the United States of America, yeah, we will go down that much. Okay, but here's the thing. I think they might be a little more intelligent this time to make sure the credit keeps flowing. And if we look at what happened in 2020, right? They made sure they kept the capital markets open, and they made sure they kept credit flowing, okay? And so I think there's a pretty low probability of that. I mean, they would rather have high inflation than have a scenario where next thing you know, we have 10% plus unemployment for a long period of time. They'd rather have pricing go up. They'd rather do whatever it takes to make sure the economy stays strong than have a situation where you have, unemployment go 10, 15%, and a situation where the credit market dries up and jobs are non-existent, right? And so you kind of get into like, what do you want? You want inflation, or do you want a depressed economy? And that's what the Fed has to always kind of balance, right? So this is very important, that this is always a possibility, but it's an unlikely possibility. And you got to understand, like, it's very few and far between you can get all the indexes to drop 50% plus. Very, very few and far between, okay? But it's always a possibility. Now, the more realistic scenario of what we're going through right now is what I would call a healthy correction, or maybe even a little more than a correction. Now, we went through one of these scenarios in fall of 2018, okay? And anybody that was in the market with me back then, it was vicious at the end of 2018. And essentially, the Russell dropped 27%, the NASDAQ dropped 23.5%, which now I think we've eclipsed this number. I think we're down even more than 23.5% as of right now. The S&P 500 fell into bear market, and the Dow was right around bear market as well. So by the time it was all said and done there, everything was basically in bear market, right? Now, the important thing to understand about that is that wasn't a scenario where it was like the economy crashed, everything was doomed, real estate crashed, and everything like that. That wasn't that sort of scenario and everybody lost their jobs. There was just the market needed to go through a very, very healthy and vicious correction, which is very, very similar to what we have going on right now, where, in my opinion, we're going through what I feel is a healthy kind of correction to the market, and it's vicious. There's no doubt about that. But you got to understand, when the markets start getting unhealthy, they've got to get back to realistic levels, right? And so if we go back to the time frame of late 2020 into early 2021, you had stocks trading at valuations that just were insanely too high. Price to sales ratio, PE ratios, forward PE ratios, price to book ratios, it doesn't matter what it was out of control, okay? Let's make this very, very clear. That is not the situation at all. Matter of fact, I want to pull you guys up something here that I think is really, really important to look at, okay? What we're looking at here on Yardini.com, Yardini Research. They always put out the forward PE metrics for companies. So what you're looking at right now is S&P 500, okay? So obviously, we were trading way too rich for way too long. Way too rich for way too long. This has come down massively. We're a little high, but we're not like, oh my gosh, this is insane. We're in kind of where we should be now, at least when it comes to large cap stocks. And that's good, okay? This was not good. This was downright scary, and you needed to correct from that. Now, where you get into another thing is when it comes to shooting too far to the downside. And if you look at mid caps, we're trading way too low right now, like way too low on mid caps. And small caps is the same exact scenario. We're trading way too low. We're at a 12.5. That's a joke, okay? Now, an important thing to understand is the market can trade unsustainably high and unsustainably low for a bit, okay? But it can't trade up there for very long. You maybe get a 6 to 12 month span where you can trade way too high or way too low on the market, but that's about it. And so if we look, we've been trading way too low on small caps and mid caps for, 6+ months now, okay? Large caps are, like I said, they're now at a point where they're in where they're supposed to be. That's the good news when it comes to large caps, but don't be surprised if those fall a little bit more here to get more in these even areas. But it's very important to understand those time periods where you're either way undervalued or overvalued. Those come very few and far between. But I think what is going on in the market, as vicious as it's been and as painful as it's been, I think it's actually ultimately a good thing long term for the market, because a market that's scary is when you look at what we just looked at and where large caps are trading at. That's a scary market, man. That's a scary market because that's unsustainable and you're coming down from that, right? And so I think it's very important to understand we could be very much going through one of those sorts of time periods right now, okay? Now, this is extremely important. So what you're looking at here is inflation rate, all right? Now, one of the reasons why the stock market has fallen so much is because inflation's been going so insane. It hasn't shown any signs of starting to slow down, and that's scared the market in a massive way because it makes the Fed way more aggressive. And the Fed's like, oh, we're going to raise rates. We're going to raise rates. Get ready, man. Half a point coming, and we're going to keep raising. We're going to keep raising. And so, the Fed, one, they've made some moves, but two, their threatening language scares the market. Their threatening language definitely scares the market big time, okay? Now, when it comes to inflation rate, I would say there's a very, very high probability that inflation, as far as the rate of increase, is likely, we're in the peak zone right now. March, April, somewhere in there is going to be peak. And then what's going to start happening is the rate of increase is going to start decreasing, okay? So what we're going to go from is like 8.5%, 9%, to then all of a sudden like 8%. 7.5%, 7%, 6%, 5%, 4%. That, in my opinion, is what's going to end up playing out here. And if I am correct on that, the way the market's going to look at that is a huge sigh of relief. The longer the rate of increase continues to go up and up and up, the more it scares the market, because the more they're like, oh, the Fed's going to raise rates a million times. They're going to, be very, very aggressive. They're going to keep scaring the market, things like that. When this rate of increase starts coming down, the Fed can start taking a step back, and they can start, taking a more, I can call it measured approach, and not talking nearly as scary, and will make the market feel a lot more comfortable than it's felt in a long time. Let's be clear about that, okay? And so, what gives me the confidence to say within the next 1 to 2 months we're already going to have peaked in as far as the rate of increase, and the rate of increase will start to decrease, okay? And we'll go from 8%, 9% to inflation to 7%, 6%, 5%. Well, one is comps year over year, and anybody that knows anything about the financial markets and the stock market, you know how important comps are when it comes to like a company's growth patterns and things like that. And one of the reasons a lot of these companies have been devastated is they came off these insane growth years, and it's hard to put up that same type of growth. The tougher the comps get for inflation, the harder it is to beat that. Also, I know a lot of people in a lot of different businesses and industries, and what I hear consistently is inflation is still ticking up, but it is much, much more tame than it was several months ago, 6 months ago, 12 months ago. And so inflation's still out there, but the rate of increase is slowing substantially from everybody I hear consistently. I don't hear anybody, like I said, I know so many people in so many different industries. I don't hear anybody saying, oh my gosh, you won't believe how much this just went up or this just went up. So that gives me a lot of confidence between the comps year over year and just knowing a lot of people that have run a lot of different businesses and companies that are basically telling me like, yeah, things are getting a little more expensive, but it's moderating now. That gives me a lot of confidence that we're somewhere around peak right now, and within 1 to 2 months, we'll actually start ticking down, which is a huge sigh of relief. And you could, the key word is could, potentially get a massive rally on the back of that, because the market will look at that and be like, now, 1 month is one thing, okay? That could get a relief rally, but if you get a consecutive month and a consecutive month where inflation continues to go down after that, as far as the rate of increase, right? Not go negative inflation, right, into deflation, but just that rate of increase decreases and decreases, that the more that happens, the more the market's going to feel more and more comfortable, and the more you can get a rally out of the market. And so these are things to consider, I think, if you're somebody that's cashed recently or you're thinking about cashing out of stocks. And yeah, I think it's also, and like I said, I want to just cover some of those points in this video, because one thing for me to say, focus on the long term, look at Warren Buffett, I look at what the great investors do and things like that. And, you guys have heard that a million times, but I think it's also another thing to consider some of these things I talked about in this video, and like what happens if the rate of increase of inflation, starts coming down, and the Fed's not as aggressive. These are very important factors, I think, to consider for folks out there. So anyways, guys, much love as always. Hope you enjoyed a video like this, and have a great day.